Forex trading can be your path to financial freedom, but only if you avoid these costly mistakes. If you're losing money in Forex, chances are you're making one or more of these 5 critical errors. Stay tuned because mistake number 5 might shock you. Leverage can be a double-edged sword. While it amplifies your potential profits, it also magnifies your losses. Many beginners risk more than they can afford, leading to margin calls or complete account wipeouts. On camera. Instead, keep your leverage low, no more than 10 to 1 for beginners, and focus on consistent growth over risky bets. Not using a stop loss is like driving without brakes. One bad trade can destroy weeks or months of progress. Set your stop losses strategically. A good rule of thumb is to risk only 1 to 2% of your account per trade. This way, even if the trade goes south, you'll live to trade another day. Market chasing happens when you see a price spike and jump in too late, hoping to catch the momentum. This often leads to buying high and selling low. Instead, focus on planning your trades ahead of time. Let the market come to your setup. Don't chase the hype. Trading based on gut feelings or random tips is a fast track to failure. You need a proven strategy that aligns with your trading style. Whether it's scalping, day trading, or swing trading, backtest your strategy before going live. Remember, consistency beats impulsiveness every time. Emotional trading is the silent account killer. Whether it's greed, fear, or frustration, trading on emotions clouds your judgment and leads to bad decisions. To avoid this, stick to your plan and take breaks when needed. Remember, a calm mind equals better trades. Now that you know the 5 most common Forex mistakes, it's time to level up your trading game. Which of these mistakes have you made? Let us know in the comments below. And don't forget to like, subscribe, and hit the notification bell for more trading tips and strategies. See you in the next video.